U.S. Treasury's plan to drain billions could spark a liquidity crisis and drive innovation in digital assets. The U.S. Treasury is gearing up to withdraw a staggering $500 to $600 billion in cash from the market over the next 2 months, a move that could send shockwaves through the financial system and exacerbate liquidity issues. This massive cash siphon is part of a broader strategy to normalize monetary conditions after years of stimulus, but it comes with significant risks. The Treasury's decision to withdraw such a large amount of cash is a critical step in reducing the excess reserves that banks accumulated during the pandemic. The goal is to bring monetary conditions back to a more normal state and curb inflationary pressures. However, this strategy also poses a risk of reducing short-term liquidity, particularly in government securities and money markets. This is where it gets controversial. While the intention is noble, the execution could have unintended consequences, such as driving up borrowing costs and creating challenges for corporate treasurers and institutional investors managing large cash balances. The Federal Reserve, which has already been actively reducing its balance sheet, may need to step in to mitigate any negative side effects of the Treasury's actions. Market participants are watching closely to see how financial institutions and central banks will respond to this tightening of liquidity conditions. And this is the part most people miss. The impact of reduced liquidity is expected to be most pronounced in bond markets, where the demand for safe haven assets could decline, leading to increased volatility. Investors and analysts are particularly concerned about the potential for tighter financial conditions to slow economic growth. Higher funding costs for businesses and households could dampen consumer spending and business investment, which could in turn affect credit markets. Tighter liquidity conditions could increase the cost of corporate borrowing and reduce the availability of credit, potentially leading to a ripple effect in equity markets, especially for companies with high leverage or weak balance sheets. To navigate these risks, market participants are exploring innovative strategies. One notable trend is the growing use of digital assets and tokenization to create alternative liquidity sources. For example, the tokenized real-world asset, RWA, market has surged to over $25 billion by mid-2025, with tokenized U.S. Treasuries and commodities like gold showing robust secondary market activity. These developments highlight the growing role of blockchain-based financial instruments in addressing liquidity challenges. Collateral-based liquidity solutions are also gaining momentum. Platforms like MakerDAO are now accepting tokenized U.S. Treasury instruments as collateral for DAI stablecoin borrowing, providing a way to access liquidity without selling assets immediately. Institutional-grade custody solutions and regulated token exchanges are emerging as key platforms to support the trading of tokenized assets, bridging the gap between traditional financial infrastructure and the digital asset ecosystem. However, despite these advancements, liquidity constraints in tokenized markets remain a significant challenge. Many tokenized real-world assets, especially those tied to illiquid sectors like real estate and private credit, still exhibit minimal trading activity and wide bid-ask spreads. This is largely due to fragmented marketplaces, regulatory restrictions, and valuation uncertainty. To address these issues, hybrid market structures that combine centralized compliance with decentralized trading platforms are being explored. Incentivizing liquidity providers and enhancing transparency through standardized valuation metrics could further improve market depth and trading efficiency. The U.S. Treasury's cash withdrawal underscores the need for coordinated action across legal, technical, and institutional domains to ensure liquidity resilience. As markets adapt to tighter conditions, the integration of tokenized assets and digital asset treasuries is expected to play a crucial role in maintaining financial stability. What do you think? Is the Treasury's plan a necessary step to normalize the economy? or could it lead to more problems than it solves? Share your thoughts in the comments below.